Good afternoon. Good afternoon. It's Monday, the 9th of September. Welcome to another edition of Monday Market Picks. My name is Thilan Wickramasinghe. I'm the head of research for Maybank Securities in Singapore. Now, despite the expected September market blues, the STI is actually holding up a lot better than expected. Why could this be? I think partly it's safe haven flows, but also I think there is some focus on the concentration of yield stocks on SGX, given the fact that you have policy rates falling very dramatically in the domestic market. At home, SORA rates are down by about 150 basis points so far this year, and there is actually more expected in the next few months as well. So today's show, we're actually going to be looking a lot on non-REITs, but low rate winners. And particularly there, we've got Hussaini joining us to talk to us about the telcos, which have been one of the key beneficiaries, but he thinks that the bullish sentiment there can continue. We also take a look at Comfort Delgro, which has just completed a transaction to buy the entire stake of Citycab and what that means. And across the causeway, we'll have Desmond Cheng who will be joining us to talk to us about Malaysian banks and what the overall rate environment means for that. And we also have a look at Japfa Comfeed and why there is a very compelling upside story there. Plus, we have some new trading buy ideas from our chart guy as well. Now, let's start with Hussaini. Now, Hussaini, welcome to the show. You're pretty excited about the consolidation that is happening in Singapore with the telco operators. We had Simba buying up M1. Why are you so excited, and what have we actually learned from global consolidation so far?
Yeah, sure. Thanks, Thilan, for having me. Yes, we are super excited and on the back of this consolidation. And on the back of that, we have upgraded our sector outlook to positive and upgraded Starhub to buy. From the global experience point of view, we have analyzed 6 markets in Asia Pac and in US. And what we have found is that post consolidation, the industry growth rate improves by almost 5 to 6 percentage points compared to pre consolidation. And if we include the market like India, then this outperformance goes to almost 8 percentage points. Okay, so in most of the markets or in 6 of the markets we have analyzed, there is a marked improvement in growth post consolidation. In markets which had seen the most intense competition pre consolidation, in India is one of the case where pre consolidation the industry revenues were declining by double digit levels. Post consolidation, the same way we are growing at double digit level. So from double digit decline to double digit growth. So markets which had seen the sharp decline pre-consolidation had seen most improvement. In Singapore fits that bill. That right now in Singapore, if we see competition is super aggressive, super intense, and for the likes of Singtel, there was double-digit revenue decline. So we are hopeful that with consolidation, we should expect to see competition improving in Singapore. One more thing to note over here is that of the 6 markets we have analyzed, in 5 markets, it was the spectator who gained market share, whereas the consolidator kind of shed some market share because of network integration issues and things like that. So that is also positive for the likes of incumbents. Given the global precedent, it is that the consolidator who end up shedding market share, whereas the spectator gains some market share.
Got it. I've got some feedback saying that some listeners can't hear. Hopefully that's been fixed now and that you can hear. Do let us know if you're having difficulties in the audio stream. Now, Hussaini, the expectation was that Starhub would actually end up with M1. Instead, what we had is Simba ending up with M1. So what are the implications for Simba? Is this like a home run for them? And what are the implications for Starhub?
Yeah, sure. See, even the wider expectation was that Startup and M1 is likely to merge. And if you see our reports on the back of that, we are of the view that if Startup combines with M1, it won't be that positive for the industry, because Simba as a number three operator or number four operator would always remain competitive with just 5-6% market share. Okay, so that was our thesis of Startup M1 merger. But now, as Simba is merging with M1, we think it is very positive. And the reason is that uh, Simba and M1 will be around 25% market share. So the new industry structure would look like that. Singtel will be around 50% market share, 50. Startup
Hmm.
and the new Mergco will be around 25%. So an evenly distributed industry that, in our view, will pave way for more rational competition and price increases. The other thing to note is that startup here doesn't have to foot the bill of consolidating the industry, right? So if you see, Simba has paid a hefty valuation, relatively hefty valuation, to acquire M1. Now startup is not paying that, okay? And startup doesn't have to go through the complex network integration process as well. So from that point of view, we are of the view that Simba M1 is a better combination, because it clearly paves way for industry competitive rationality, and startup is also relatively better place because they don't have to pay foot the bill, as well as they don't have to go through the complex network integration process.
Okay, got it. Now, you've actually upgraded Starhub to a buy with this, and I think this is actually amongst the first upgrades after all these transactions happen. So, what's actually driving your optimism here?
Thilan, one of the optimism we discussed is that if we look at the global precedent, consolidation does help for helping the industry competitive rationalization. That's point number one. Second is, if you see the Singapore in the last 5-6 years, especially after the entry of Simba, it has been intensely competitive market, and the ARPUs of the telcos had declined by almost 37 to 41%. Okay, and if you see the ARPUs of Singapore vis-a-vis that of other developed Asian markets, Singapore ARPUs are the lowest. It is almost 15 to 40% below that of other developed markets like, say, Australia or Taiwan or Korea or Hong Kong. Okay, so clearly Singapore has bettered quite a lot, and there is room for improvement. So there's the second catalyst we see. The third is that if you see the combination of M1 and Simba, and that's questions we get quite a lot. That's one of the investor concern, that whether they will have a better revenue structure than the Mashco, and can they be competitive, whether they will have a better cost structure. In our analysis, we don't find any such thing. We are
Hmm.
of the view that M1 also has a similar legacy issues as the incumbents, like roaming revenues, voice revenues, as well as caller ID. And 75% of the Mergco revenues is M1. So Mergco will similarly face legacy issues, and as such, they don't stand out. On the cost side as well, we find that they don't have any marked cost advantage. There will be network integration issues. There are network vendor issues, because Simba's network is on Huawei, whereas M1 is on Ericsson and Nokia. So that creates issue. Balance sheet will also be a very big factor as far as the Mergco is concerned, because their net debt to EBITDA will go to 4 times post consolidation, which in our view is quite elevated. So as such, we don't find any advantage in favor of the Mergco, and that kind of indicates that most likely they will participate in competitive rationality rather than being aggressive in the market. So from all this point of view, we are of the view that it is net positive for the industry, and that's why we upgraded the sector outlook to positive and upgraded startup to buy. Means the point is that if you look at Starhub's mobile revenues, they had been under a declining trend. We expect that by next year, it should improve to 4 to 5% growth, maybe for 2026 and 2027. That is
So
driving
make
our upgrade.
so make hay while the sun shines, huh? Okay, so I just want to close off by also asking about Singtel, where you actually bumped up the target price by about 10%, and you're keeping that a buy as well. So I mean, you've upgraded the entire sector, the telco sector, to positive. So what's the market missing with Singtel?
Okay, Singtel, it remains our key pick. And if you see, means Singtel, I see the way I see Singtel has 8 business units, 4 core and 4 associates. And I'm of the view that at this point, all the 8 are in good shape. And the latest one to join is Singtel Singapore on the back of consolidation. So means that was a key concern that Singtel Singapore was under pressure because of competition. Now with consolidation, we are hopeful that that will improve. The other area where I'm of the view that the investors are or street is missing is the digital infraco business. Now, next 3 4 years look super good for them, and it is very well known because of the new data centers ramping up. But I am of the view that beyond 2028, FY28, we expect a similarly elevated growth, and that is for 2 key reasons. First is that on the data center side, we expect company to uh, uh, put in more capacities in Singapore. Singapore government is going through the CFA2 call for application, which is the second tranche of new data center development. And I'm of the view that Singtel is likely to participate and likely to win new capacities, as well as Singtel is going beyond Singapore to other tier 1 markets like Japan and Korea in partnership with Hitachi. So that in our view is also a key positive. Also in the AI space. So in the last 1 or 2 years or so, Singtel was more in a experimentation phase as far as GPU as a service is concerned and AI as a service is concerned. Now that experimentation phase is over. They have quite a bit of visibility. So going forward, they are going to scale up that business, deploying GB200 and GB300 GPUs from NVIDIA at scale. So that in turn should also add in new revenues. So those are the areas where I am of the view that the street is missing. Optus is also one area where things are improving, but I'm of the view that from 27% margins, it can hit mid 30s kind of margins, which also is ahead of street in our view. So those are the areas of positive momentum for the company.
Got it. So a lot of engines firing, a lot of positive momentum. So keep an eye on Singtel. Thanks, Hussaini. That's all the time we have for you today. Now I want to turn our attention across the causeway to Malaysian banks. We've got Desmond Cheng joining us. Desmond, welcome to the show. Now, you wrap up the first half results for the Malaysian banks by saying no bad news is good news. Can you explain your thinking here?
Yeah, hi, Dylan. So it's actually what I mean by this is when we entered into the first quarter of this year itself, we saw that there were more disappointments for the banks in that out of the 9 banks within our coverage itself, 5 actually disappointed in terms of earnings. Whereas this round, we saw that out of all the banks within our coverage, at least only one bank disappointed in terms of earnings. So that's what I mean by the fact that no bad news is actually good news. But the whole point about this is that when you look at the operating environment for the banks at this point in time, it's still quite challenging for the Malaysian banks. The second quarter, for instance, was marked by ongoing quarter-on-quarter contractions in margins and slower loans growth as a whole. In fact, the cumulative loan growth for the banks within our coverage was actually less than 4%. But this was, in effect, partly due to the foreign currency translation impact
Mm.
for the regional operations of the likes of Maybank and CIMB, so that it's kind of distorted to some extent. In fact, local domestic loan growth at this point in time is about 5.4% for the industry. But then coming back to the results for the second quarter, we saw slower loan growth. We still saw contraction in margins, but on the bright side, the non-interest income side was still robust and expenditure was still under control. So generally, for the first half of this year, cumulative core net profit for the banks within our coverage rose by about 3% year on year on the back of a 3% increase in operating profit as well. Into the second half of this year, the outlook still remains challenging, that because we had an OPR cut of 25 basis points in July, this is probably going to add to near-term NIM pressure as a whole. But again, we expect it to be buffered by the fact that domestic loan growth, we're looking at about 5% for the year. We're looking at non-interest income sustaining to some extent. Overheads are still okay, and credit costs are particularly benign. So on a cumulative basis for the stocks within our coverage, we're looking at operating profit growth of about 3.5% this year and net profit growth of 2%. But on a brighter note, into 2026, we're looking at operating profit and net profit growth of about 5% respectively. ROEs averaging about 10%, and dividend yields are still attractive at more than 5%.
Okay, so slightly more accelerating momentum going into next year. So that actually kind of brings me to your stock picking strategy. How should we think about Malaysian banks definitely going into the second half and certainly going into 2026? What are your top picks there?
Yeah, so essentially we're playing it safe to some extent, and we're focusing firstly on more domestic driven banks, and in particular the retail banks, given that at this point in time, there's still volatility on the external front, and given the fact that we're still looking at Malaysia's GDP growth coming in fairly moderate at 4.2% for this year and 4.1% into next year itself. So the top three picks at this stage will be Hong Leong Bank, AMMB, and Public Bank. In the case of Hong Leong Bank, the asset quality is strong with a GIL ratio of just 0.5%. Their loan loss coverage is 259%, and the balance sheet is liquid with a loan to deposit ratio of about 87% and liquidity coverage ratio of 132%. The positive part is that because they raised their dividend payout ratio to 46% from 33% in FY24 itself, its dividend yield now is more than 5%, which brings it more or less in line with that of its larger peers. In the case of AMMB, we're looking at its focus on proactive funding cost management, as well as its focus on business banking to drive the growth momentum for the group itself. They're also looking to raise their payout ratio of a dividend payout ratio. We currently have it at about 50%. They could potentially raise it to about 60%, at the timing of which hopefully will be sooner rather than later. And finally, in terms of Public Bank, it's well managed. It's got management overlays of about 1 billion to keep its credit costs low. And the recent acquisition of LPI Capital as well should serve to enhance non-interest income. I think one concern that people have over Public Bank is the share overhang issue, given that the family has a restricted offer of for sale of a stake of about 12% of Public Bank for the next 5 years. So this works out to be about 2.38 billion shares on offer to be distributed over 5 years itself. The thing about it is that given that Public Bank's monthly average daily trading volume is about 20 billion, this should be more than sufficient to offset or to absorb the new supply if it comes on stream. So we're actually not too concerned over the share overhang issue per se for Public Bank. So yes, those would be my top 3 picks for this sector.
Got it. So Hong Leong Bank, AMMB, and Public Bank. Thanks for joining us, Desmond. Now, back to Singapore, Comfort Delgro has been a mid-cap that has actually lagged the overall mid-cap rally quite a bit, and that's kind of surprised us. But we actually think this gap will close, and Eric's latest views on the CityCap deal actually supports this. They completed the acquisition of the remaining 46.5% stake in CityCap from ST Engineering for 116 million Sing dollars, funded through their own bank facilities. The transaction will deliver about one-off disposal gain of about 77 million for ST Engineering, plus some annual interest savings of around 4 million as well. For Comfort, the deal is earnings accretive and is priced attractively at around 3.9 times EV to EBITDA and 8.6 times PE, with an estimated contribution of around 2 million Sing dollars, which will actually increase EPS by about 1%. The full ownership of CityCap's 8,000 vehicle fleet enhances the integration of its point-to-point business in Singapore and supports its global ride-hailing strategy and underpins future investments in their ZIG platform to drive differentiated service offerings. All of this points to a much more streamlined strategy for Comfort, which has also shown pretty good execution of its overseas businesses, which now contribute more than 50% of revenues. So I think a lot of positives are aligning behind Comfort, and we think that this will provide for the company to close some of that performance gap. So we are reiterating a buy call there. Now, before I go on to our next stock, I've got Andrew Lim here, who's asking, with the uncertainty in Thailand and the unrest in Indonesia, what does this mean for foreign flows to those markets? And does that have an impact on the rest of ASEAN? I think pretty valid points. And I think when I started our show today, I said Singapore is actually holding up a lot expected, and I suspect some of those foreign flows are moving to Singapore from a safe haven point of view, also from a yield point of view. But having said that, I don't think you should completely forget Thailand at this stage. Our strategist there thinks that a lot of the bad news is priced into that market. We've got a new prime minister in place and a new technocratic cabinet in place as well. So there might be some potential for some near-term upside in that market as well. But I think largely there has been a rotation into Singapore when you think about ASEAN in isolation. Now over in Indonesia, Jocelyn Santoso's come back from a visit to Japfa Comfeed facilities with some very positive impressions. They stand out as a compelling buy in Indonesia. The group is an integrated poultry leader with a quarter of the day-old chick market and 20% of the feed market, giving it pretty strong scale advantages. Efficiency gains from digitalization and better raw material management is supporting margins, even against some of the very volatile corn prices. Beyond poultry, their consumer food arm, So Good, is growing fast as well, projected at over 20% sales growth next year, with high margins and more stable earnings as well. Structural demand tailwinds are also in play, with the government's tripling of its nutritional meal program budget, which directly drives poultry consumption. And valuations are attractive as well, just 6 times forward earnings and 8% dividend yield. So pretty attractive. So do have a look at Japfa Comfeed in Indonesia. With that, let's quickly move to our chart guy. We've got two trading ideas. OILTEK has staged a bullish reversal breakout, and the breakout signals potential for further upside as well. So do have a look at his overall analysis there. And also Union Gas, which has given up a lot of gains from very sharp profit taking, but we are starting to see new buying interest emerging as well. So do have a look at that as well. With that, unfortunately, we are out of time. Quite a few data releases over the next couple of weeks. Nordex out on the 17th, unemployment rate out on the 12th, and PMI out on the 3rd of October. So we'll bring our views on those as we progress. Thank you very much. And just before you go, I do want to say thank you very much for all your support in helping Maybank win the best research for Singapore in this year's Euromoney Awards. So thank you so much for your support and have a profitable trading week, and we will see you next week.